All right, so now that we've been through how a simple LBO model works, let's actually go ahead and use a practical example and start filling out some of this information. So in this scenario, we're going to assume this company has a EBITDA of, I'm going to go, make sure to label your data correctly. We're going to assume this company has a EBITDA of 1,000, which is basically equal to $1 million because we're writing in thousands. Now we're also going to assume that this company has a multiple of 10 that we're going to pay for it. Now I'm just going to copy the formatting of this one. There we go. So we're going to pay a 10 times multiple for this business, which means that the enterprise value for this business is going to be $10 million. Now we also know that this business, when we bought it, has $1,000, sorry, it also has $1 million of cash and $1 million of debt. We're going to write debt as a negative here. So essentially, these two net off, which mean there is a net debt amount of 0, which mean that the equity amount is same as the debt. And they're going to leave this in the business. They're not going to take this out pre-acquisition. Otherwise, it wouldn't form part of your completion. So this is how much we're paying for the business. So we know that this 10,000 needs to equal the sum of these two numbers here. I say these two, not the entire total, because the transaction fees are going to be on top of that. So let's start off with transaction fees. Let's, or maybe we start off with the percentages here. So in terms of how much we're acquiring of this business, let's say we're acquiring, let's say we're acquiring 80% of the business, which means that the existing shareholders are going to keep 20%. So we can go 1 minus that. So that adds up to 100%. So this is going to be the cap table going forward. Who's going to be a shareholder in the business? We're acquiring this 80%, and the other shareholders, let's say the founders of this company, are retaining 20%. So we know that the sum of these two needs to equal to the equity value. So what we can do is we can just say that times that, and we can see that that now adds up to the 10 million. But in a transaction, you're also going to spend money on transaction fees. So let's assume that we're going to spend $500,000 on transaction fees in this deal, which means the total uses or the total need for capital is $10.5 million. So this $10.5 million needs to be funded somehow. So it's either going to be funded by how much equity we're putting in as investors, how much money the shareholders are rolling over, and this should really just equal the same as that, right? Because they're just rolling, we're saying that their shares are worth $2 million, and they're essentially funding that with equity being rolled over into the business. So they're essentially funding that with their own equity. Now, in order to make up the rest of this amount, $10.5 million, we need to fund some with equity, so our own money putting in, and we can put some money in debt. Now, how much debt you can get depends on how large the business is, what the debt market's like, whether you have other assets as collateral, and various other things. So typically for a small business like this with only $1 million EBITDA, you're only typically going to get about 2 to 3 times your EBITDA in leverage. But for large businesses, this could be like 5, 6, 7, 8, even like a high as 9 times. But for this range of business, we can only probably get about, at most, let's say 3 times that EBITDA. So we've now got $5 million here. This essentially means that we as investors are going to fund the difference. So essentially, it's going to be the difference between this and this. It's a circular reference, but the number that we're trying to back solve for is 6.5 million. Sorry, my bad, 5.5 million. So that's how much money that we are going to have to put in as investors. Okay, so that's the first part of this model solved. That was easy enough. But it's a bit more work to figure out how much we're going to get out of the business, because we need to model out how much the EBITDA is going to grow at exit, what multiple we can get, how much cash is going to be in the business at exit, and how much debt is going to be in the business at exit. So, as we discussed in the last video, the first thing we're going to need to do is figure out what EBITDA is going to be at exit. So we need to calculate our profit and loss. Now, when we first bought the business, we don't have the revenue here, but let's assume that the revenue was 10,000. Just going to copy this formatting. Let's assume that when we bought the business, the revenue was 10,000 and the EBITDA was 1,000. Actually, I'm going to feed them into this section here, actually. Okay. So this is our starting point. We're assuming that we bought the business in FY22A at completion. However, we're going to sell the business in this last year. So we're essentially assuming 1, 2, 3, 4 years of growth. You could even factor in a 5th year if you want, but we're going to keep it simple like this. Now, in terms of the growth rate that we're going to assume, let's put in a percentage point to reflect the growth rate. So let's assume this business is growing at 6% revenue and 6% EBITDA. So again, these are very simple calculations. You could also do it as a margin. So for example, you might assume that revenue is growing at 6%, but maybe you think you can save some costs and grow the EBITDA margin and therefore EBITDA faster than you could revenue. So now we can see in year 2026 that we think revenue is going to be 12.625 million. Now EBITDA, on the other hand, let's say this is going to grow at 10%, or maybe we can say that instead of another way of doing it, let's do it on a margin basis. So let's assume that, so the margin from last year was 10%. Let's add 0.1% or 2% each year. So we're going to get that margin up to 12%, etc. I'm just going to add in an extra row for margin. We'll do it down here instead. And that way it gives us a toggle to either do fixed revenue growth or change the percentage. Okay, so what I want to do is I want to make the margin grow each year 2%. So let's assume we're going to go this plus 0.2. So again, pretty simple. In a more detailed model, you'll have a much more detailed assumptions page about what's going to happen to your margins, which means that our EBITDA is going to grow to 2272, so significantly higher. Sorry, I'm just going to fix my border. Significantly higher than if we just did, say, 6% growth rate, because we know that the EBITDA margin is growing, as is revenue. Therefore, yeah, EBITDA is going to grow at a faster rate than 6%. So here's our EBITDA. We also want to know what our interest expense and our depreciation expense are as well. Now, our interest expense, we can actually link into our debt schedule down here when we get to it. So let's come back to that one. And depreciation amortization, let's assume that it's going to be 1% of revenue each year. put this as a negative number. There we go. And our profit before tax is essentially going to be the sum of this and this. And we know that our profit before tax is lower than our EBITDA, so that makes sense. So we just need to figure out what and let's just link it like this. So we use a color scheme so we know that we need to come back to it. Now we also know that this company needs to pay tax, right? So we need tax because later when we calculate the cash flow, we need to know how much cash is being paid out of the business for tax. And tax we can't just calculate straight off EBITDA because there's also deductions down here. So what we need to do is times this by this. And I've locked the first cell. So you can see as we drag it along, it's still linking to this one over here. So I'm going to make these negative as well because it's a deduction. And that means our profit before tax is just equal to the sum of those two numbers, which is profit before tax less tax paid. Okay, so next we also need to know cash flow. So we already know our EBITDA because that's linking up here. But EBITDA is not the same as cash flow. There's other things in between. For example, working capital movements, capital expenditure, tax, interest, and then any payments towards your paying down your debt. Now, net working capital, you can put it at its own line and call it change in net working capital, or you can just call it something like this, operating cash conversion, which is another simplified way of just saying, after the change in net working capital, what is the percentage of EBITDA that equals to your operating cash flow? Operating cash flow is basically your EBITDA less your net working capital movements. So for this business, it's pretty high cash gen. So we're going to assume 90% for this business. That basically means of every dollar in EBITDA that we're getting in the business, 90% of it is actually converting into cash from operations before we've paid any tax or before we've paid for Capex, etc. So it's a pretty high cash gen rate. It means that it's not a very working capital intensive business, which is good. And it's something that private equity firms will look for. Next, this business also pays Capex. Now, Capex is a balance sheet item. It's not going to be in your P&L because when you pay for property, plant, and equipment, for example, the journal is debit PP&E, which is an asset, and credit cash. So it's never going to hit your P&L. It's only going to hit your balance sheet. But we do need to factor into cash flow because it does come out of cash. Now for this business, we're going to assume also 1% of revenue. So we're going to go negative revenues up here times, I'm going to hard code, I'm going to fix this one here and bring that across. We already know what the tax paid amount is. It's 270. Okay, so that's already flowing through, and tax paid is a cash item. So we do need to factor that in. So as we can see, we now know what our cash flow is before we service any debt. Now, the first thing, you'll see another one, we've got interest expense, bank interest cost. So we're assuming in this example that interest is being paid down as we go. But, you know, there's many loans called payment in kind where essentially the interest just accumulates and you pay it down when you exit the business. In which case, obviously, there's not going to be any cash flow outflow for that kind of loan. But you would still get the expense here, just like depreciation, how it's not a cash flow item, but it is a deduction for tax purposes. So in that case, you'd include it here, but not here. But in this scenario, we're just going to assume that we are paying it out every year. Bank amortization payments is essentially how much we're paying down on our principal on our loan. So we're going to link this to our debt schedule as well. So we'll come back to this one. So down here, we've got our cash balance. Our cash balance is essentially how much we've got in the business to start with, right? Plus the cash generation throughout the year. And that gets to our closing balance. You can see how that flows through every single year. And the movement in cash is that. So that's pretty straightforward. There's nothing else we need to do. We can see when we exit the business, we're going to have this much in cash. So that's going to flow down to our proceeds, our sales proceeds over here. We need to figure out debt schedule, and we also need to revisit some of the areas at the top because we're relying on the interest calculation here. So the first thing is opening debt of 2,000. So I might just correct this formula here so that it's consistent. We'll do a positive number here, and then we will essentially change this formula so it goes that plus that, and then minus that. And that way we know that our formula down here is flowing through correctly, because we can see now opening debt schedule is the sum of our debt that was already in the business plus our bank debt that we put in the business in order to fund this acquisition. So we've got 4 million on the balance sheet. We're assuming 4% interest paid, 4% interest rate. So let's see. So opening year, interest paid. So what we want to do for interest paid is essentially we're going to take the total debt times that, and we're going to subtract. I'm going to make it a negative. So draw down interest paid. What I'm going to do is I'm actually going to move this above the line, and I'm going to move this one to the previous year. So now it just flows through like this, where we've got our opening debt plus any new debt during that year, less, sorry, we want to do a positive, don't we? Because that's essentially going to, oh, sorry, no. Let me go back to how it was, because we're not actually paying down any principals, so this was actually correct. Ignore what I was saying before. Interest paid is basically paid in addition to your principal and interest loan. So that was actually correct. But what we need to know down here is how much we're actually repaying on this loan. And of course, if it's a payment in kind loan, why isn't this working? Sorry, I'm fixing the wrong number. There we go. So if this was a payment in kind loan, aka the interest accumulates, then you would move that above the line, because we wouldn't be paying out our cash, but we'd be accumulating that in our debt balance, and we'd be paying it off at exit. But we did say in this scenario that we're going to be paying this cash out every period. So this is correct. And we're going to link this in like so. Okay, cool. So the only thing that we need to know is how much we're actually paying down from our loan. So I'm just going to format this. We can do this in a couple of ways. We can choose an amount that we're going to pay down, or we can do it, or we can just use all available excess cash to just pay down our loan. So why don't we just assume 0 in the first year, and then from each period thereafter, maybe what we could do is assume the difference between the two. And that's essentially going to get us down to 0. Essentially what that means is we're paying all of our excess cash every single year into paying down our loan. Now the tricky thing is we want to make sure that our calculation doesn't actually pay down more debt than we've actually got in our balance sheet. So we can just do a simple calculation here where this links into the amortization payments. Oh, we've got a circular reference. There we go. I fixed it by linking it to a previous period. So now, as you can see, it's paying down this debt, and we've still got an amount left over, so that's fine. However, if we found out that we were actually paying down more than the debt amount, we'd need to actually put in a formula to prevent that. But for now, what we can do, because we just want to keep it simple, is we can just put some checks down the bottom. The first check is going to be total debt paid down. Total debt amount. And check equals if that is less than that. Okay, otherwise error. Sorry, got the sign around the wrong way. Okay, so there's our first check. So down here you can put all kinds of checks. It's a good idea to put as many checks as possible because there's so many different ways you can make a mistake, or the numbers might change. Like we might change our assumptions later, and then it might not be out now, but it might be out later. So what I like to do is just go text okay is green, text error red. Perfect. So that's our first check done. So that's okay. Again, this is a simple LBO model, so I'm not going to spend too much time on making fancy correction errors. So that's fine as is. Now, okay, so we've done our cash balance. Notice the cash is significantly lower because we're using all of our excess just to pay down the debt. And notice how our debt schedule here, our debt's being slowly paid down, so we almost have no debt by the time we get to exit. And now we can finally calculate our exit price. So we choose what year we want to exit in, so we can change the year here. Maybe it's 25, maybe it's 26. Obviously the EBITDA is going to be higher in 2026. For exit multiple, we're assuming some increase in the exit multiple. So we bought it at 10 times, we're assuming that we can sell it at 12 times. Transaction costs, we can assume, let's assume 1% of equity value. So 273,000. Bump this up to 2% actually, 500K, that sounds about right. Net debt, we know, is the sum of your cash minus the debt at closing. So that's good. And then our equity value is essentially the sum of your enterprise value less your transaction costs, less your net debt. I guess technically we should split out transaction costs from equity value, but that's fine. This is essentially going to be our proceeds. The other thing we need to do is what is our investors' proceeds of this? Well, it's going to be 80% that we own of this business. So we are essentially, as investors, going to get 80% of that, which gets us 22. So essentially, if we run the numbers again, but this is general. We run the numbers again. We've essentially put in 5.5 million in year one, and by 4 years later, we've come out with $22 million. So we've essentially 4 times our money at an IRR. Hold on, we just need to correct this because this is a negative for IRR. Oh, sorry, we just need to correct the date. It doesn't recognize it as a date at the moment. IRR at 40%. So this is a really good return on this deal. So now if we go back to the top, we've put in 5.5, which is this number here. We've gotten out 22.2. This is a money multiple of 4 times. We can just link it down the bottom actually. And an IRR of 41.4%. So should we be doing this deal? Absolutely. And that's pretty much a simplified LBO deal. So here's a question. If you had $5 million, would you put it in to get out $22 million in 4 years? The answer is yes. Yes, you should. This is a really good return. Now, we can always play with all the levers, change the assumptions, see how debt's changed over time. Maybe we keep the exit multiple the same as well. There's a number of different things you can do with this, including running sensitivity on all of those assumptions, because obviously our model is only going to be as good as the input assumptions that we're putting in. We can leave that for another video. So hopefully you found this useful. Thanks for watching.